role of a bank funding group in a bank's operations. Understanding funding and its significance in banking. Overview. Introduction to bank funding. Key responsibilities of a bank funding group. Funding sources and strategies. Risk management in bank funding. Impact of economic conditions on bank funding. Definition of bank funding: capital raising. Bank funding involves raising capital through various sources such as customer deposits and loans from other financial institutions. Investment activities. A capital raised through bank funding supports lending and investment activities, allowing banks to engage in financial markets effectively. Liquidity management. Maintaining liquidity is essential for banks to meet their financial obligations and fund operations, which is facilitated by diverse funding sources. Importance of funding in banking operations. Ensures liquidity. Effective funding is crucial for ensuring liquidity within banks, allowing them to meet their short-term obligations. Supports lending activities. A strong funding strategy supports lending activities, enabling banks to provide loans to individuals and businesses. Risk management. Proper funding helps banks manage risks effectively, ensuring stability and compliance with regulations. Regulatory compliance. A well-structured funding strategy allows banks to meet regulatory requirements and adapt to market changes. Overview of a bank funding group. Funding needs management. The bank funding group manages the bank's overall funding needs, ensuring adequate resources are available for operations. Coordinating funding sources. This group coordinates various funding sources to optimize liquidity and ensure financial stability for the bank. Cost optimization. A key responsibility is to optimize funding costs while maintaining financial commitments and competitiveness in the market. Managing liquidity and cash flow. Liquidity management. The bank funding group plays a crucial role in managing the bank's liquidity position to ensure stability. Monitoring cash flow. Monitoring cash flow is essential to guarantee that funds are available for withdrawal and obligations. Withdrawal management. Ensuring sufficient funds for withdrawal demands helps maintain customer trust and operational efficiency. Securing various funding sources. Diverse funding sources. The group aims to secure various funding sources to enhance financial stability and flexibility, including deposits and loans. Mitigating risks. Diversifying funding sources reduces risks associated with relying on a single source, ensuring a stable financial environment. Interbank loans and capital markets. Utilizing interbank loans and tapping into capital markets are essential strategies for securing necessary funding. Ensuring regulatory compliance. Importance of compliance. Ensuring compliance with regulations is essential for maintaining trust and stability in the banking sector. Regulatory requirements. Funding activities must meet capital adequacy and liquidity standards established by banking authorities to ensure financial stability. Ongoing monitoring. Continuous monitoring of compliance is necessary to adapt to changing regulations and avoid potential penalties. Funding sources and strategies. Deposits and customer accounts. Primary funding source. Customer deposits serve as the primary source of funding for banks, enabling various financial operations. Financing loans. Deposits are crucial for financing loans, facilitating the bank's ability to lend to customers and businesses. Importance of liquidity. Customer accounts are vital for maintaining a bank's liquidity, ensuring it can meet withdrawal demands. Interbank lending and borrowing. Definition of interbank lending. Interbank lending refers to the practice where banks lend and borrow from each other to support liquidity needs. Importance of liquidity. This lending process provides a vital source of liquidity in the financial system, ensuring stability and efficiency. Managing funding needs. Interbank lending helps banks effectively manage short-term funding requirements, facilitating smooth financial operations. Market-based funding. Bonds, commercial papers. Bonds as funding instruments. Bonds are long-term debt instruments that banks issue to raise capital from investors, enhancing their funding capabilities. Commercial papers. Commercial papers are short-term unsecured promissory notes used by banks to meet short-term financing needs efficiently. Capital raising flexibility. Market-based funding tools offer banks flexibility in raising capital, allowing them to adapt to changing financial conditions. Identifying and mitigating funding risks. Identifying funding risks. The bank funding group needs to identify various funding risks, including interest rates and liquidity risks, to safeguard financial health. Interest rate risks. Interest rate risks can significantly impact funding costs and should be monitored closely to avoid financial instability. Liquidity risks. Liquidity risks can affect the bank's ability to meet short-term obligations, making their identification and mitigation essential. Mitigation strategies. Implementing robust strategies to mitigate identified risks is crucial for maintaining the bank's overall financial stability. Stress testing and contingency planning. Importance of stress testing. Stress testing helps banks assess their ability to withstand financial shocks and maintain stability in adverse conditions. Role of Bank Funding Group. The Bank Funding Group plays a crucial role in conducting stress tests and developing strategic contingency plans for funding challenges. Contingency planning. Developing contingency plans ensures banks are prepared for potential funding challenges and can respond effectively in crisis. Role of central banks and regulatory bodies. Oversight of funding activities. Central banks and regulatory bodies monitor and oversee the funding activities of banks to ensure financial stability and accountability. Maintaining adequate liquidity. Regulatory bodies provide guidance to ensure banks maintain adequate liquidity, which is essential for smooth financial operations. Adherence to prudential standards. Central banks enforce prudential standards that banks must adhere to, promoting sound banking practices and reducing risks. Economic cycles and funding availability. Impact of economic downturns. Economic downturns create challenges for banks in securing funding, often leading to tighter capital controls. Favorable economic conditions. In favorable economic conditions, banks generally have improved access to capital and funding opportunities. Bank funding dynamics. The dynamics of how banks secure funding can fluctuate significantly with the economic cycle. Impact of interest rates and monetary policy. Role of interest rates. Interest rates set by central banks directly influence the cost of bank funding, affecting overall financial stability. Monetary policy changes. Changes in monetary policy can lead to various challenges and opportunities for banks, influencing their funding strategies significantly. Funding strategies. Banks must adapt their funding strategies in response to interest rate changes and monetary policy decisions to remain competitive. Global financial crisis and funding challenges. Impact on funding availability. Financial crises often lead to a significant reduction in funding available to banks, making it challenging for them to operate. Lessons from past crises. Analyzing past financial crises provides valuable lessons on risk management and funding strategies for banks. Preparation for future challenges. By understanding historical funding challenges, banks can better prepare for future financial crises and mitigate risks. Conclusion: operational efficiency. The Bank Funding Group enhances operational efficiency through strategic management of funding sources and resources. Financial stability. By managing risks effectively, the Bank Funding Group contributes significantly to the financial stability of the bank. Adapting to economic conditions. The group plays a vital role in responding to changing economic conditions, ensuring banks remain competitive. Thank you.